2023 was a mixed year for the private equity venture capital ecosystem. While investment figures were down sharply year on year, the public markets and hence exits fared quite well. With election season ahead of us both in India and USA, 2024 already promises to be a quite an event-filled year. How are leading PVC investors and advisor firms reading the tea leaves, and how are they tweaking their strategy accordingly? We have a range of expert speakers lined up throughout the day to address these aspects in a detailed manner. So, to structure today's day's proceedings, from the private equity and growth capital focus panels in the pre-lunch session to the venture capital panel in the afternoon, the speakers will deep diving into specific issues relating to each segment of the private equity ecosystem. And between the sessions, will be reorganizing the best performing PVC investors of 2023. We now take the opportunity to thank our title sponsor Trilegal and our powered by sponsor Veda Corporate Advisors for making this event possible. Thanks to all our other sponsors, Technology Holdings, Aditya Birla Ventures, Arali Ventures, Chris Capital, Gaja Capital, and TVS Capital, as well as our knowledge partners, Intequent Advisors, EDM Capital, AVA, and Cap 70 Angels. With that, to set the stage for the panels to flow, let us start the day's proceedings with a presentation on what the data says on the state of private equity venture capital in 2023. To present the data, I welcome our founder Arun Natarajan, from Venture Intelligence, to present the data before the panel starts.
Thank you, Sonal. So this is just to set the stage for the panel to follow. This is obviously a rear view picture, and these folks will let you know what's lying ahead of us. Quick word about venture intelligence. Tracking private companies for a living is our bread and butter, whether it's their financials, their valuations, the multiple transaction opportunities, private equity, venture capital, M&A, and so on. So a bit of what we do on this slide. What's been happening, in 2023, looking back, like I said, no secrets, year on year numbers are down and down sharply. Compared to 2021, obviously, it looks slightly, better, but the cliff off the cliff is clearly something that's top of mind for everybody. So 38% down by value terms. This is 22 to 23, right? So let alone 21 is the point. 45% down in terms of volume terms. So that's clearly off the cliff. So let's see if there's any room for optimism here. Breaking it down by quarter, the last quarter of 23 kind of indicated that probably the worst is behind us in terms of fall. Look at the steep tower of Q3 2021. So you're not even looking there. Just look at the second portion of the slides. Things are bouncing around quarter on quarter basis, and maybe the panel can educate us. Are they seeing some green shoots for a recovery? What are the kinds of deals that we've seen? Obviously, from the beginning of last year, Manipal Hospitals, followed by HDFC Credila that Chris was a part of, and then they had Reliance Retail, and we had a bunch of other sectors contributing. Very noticeable here from some of the top deals as well, and as well as through the year. IT is the one that has fallen off the most, right? The share went up, to 70%, of all the transactions, private equity, including venture, that is, but now it's kind of reverted to the mean, I would say, back to the 30 odd percent that we've seen in the past. If you look at the first one, which is 2018, kind of back to where that was 23, 5 years since. So, and then what has gained as share of the pie? Healthcare has been noticeable in terms of the contribution it has made in the overall private equity pie chart, and financial services is always there as well. From a by stage perspective, very noticeable one here is the share of buyouts has clearly gone up. That's the one in the orange for you, $9.6 billion last year. Very obviously the growth stage has come down significantly. In terms of, again, any good signs to kind of indicate there is some lot of dry powder in the system. $20 billion have been raised, including some folks in the panel as well, in the last 2 years. So there is plenty of dry powder. How much is that of that is going to get deployed when the panel can educate us? uh, the kind of funds that have raised private equity, especially. So we had, Kotak raising a special situations fund. We had multiples, which had its fourth fund up, and we had some venture funds as well, contributing significant to the fundraising pie. So again, I would, as Sonal mentioned, one of the uh, highlights of 23 was the fact that exits, are doing comparatively well compared to investment. As you can see, it's outdone 2022. Uh, can we have the PPT done on this? Yeah. So again, look at it by quarter. Things are quite stable. We are doing around 70 exits per quarter. What are the deal types? Obviously, public markets are booming and hence IPOs are as well. And quite a few of the funds have taken advantage of that. But secondary sales is probably the mainstay of the ecosystem, and that is contributing to even venture exits, as we will see a bit later in the day. Some of the exits, the big ones, Flipkart, finally Tiger and Axel sold off. So that was the largest deal. Manipal Hospital saw a secondary transaction as well. Coforge, which is NIIT Technologies, Baring Asia got out of it. Mankind Pharma, Chris Capital was involved again in an IPO and then a subsequent to IPO sales. This is, how the IPOs are faring. The volumes are up, off from 2021, but here are the kind of top IPOs, this thing, topped by Mankind Pharma, and we had Tata Group, Growth Capital Fund selling from Tata Technologies, again a very well received IPO, and we ended the year with Mamaearth, which is more of a venture-backed IPO in that sense. So IPOs, continue to tick on, and I will leave the panel to kick off on this positive note. Thank you so much. Over to you, Gautam. And introduction of you, Gautam, and then before that, hold on.
Thank you so much, Arun. To start the panel discussion, I would like to introduce the moderator of the session, Gautam Singh, partner at Trilegal. Gautam Singh is a part of the corporate practice group at Trilegal. He primarily focuses on merger
entrepreneurs, and especially post-COVID, how have you seen the PE market shape up in India?
Sure. Hey, um, good morning. I'd like to start with thanking Arun and his team for having me here today as a part of this distinguished audience as well as panelists. Such. Um, I'm pretty excited to be here and to talk on this topic, which is about how are we seeing a different kind of a PEVC system. To be very candid, I've been in the PE system just for about like a little more than a year. I was a part of the VC system for about like 15 years before that, right? And I've seen both markets mature and decided to make the transition as such. And in the year that I decided to make the transition is the year that he's asking this question about as well. The thing that struck me was that there is a deep maturity which is coming into the markets, which is very different from what it was before. The exits, the way deals are structured, the way actually like people are looking at investing, how funds themselves choose to deploy capital, every single thing has been both challenged and proven in India. Most people typically end up talking about the quality of entrepreneurs. That's been great for quite a few years. For the last decade, it's been really very good, fantastic. So I don't think like I want to repeat that part of it. It's a known story and a known DNA. And it's also about like the capital availability becoming like quite significantly available on the back of improving business models, safety of environment, the ability to enter and exit, the ability to actually like construct yourself, to work alongside partners, to build capabilities within firms and, like actually like see them right through the life cycle of startup seed to all the way up to IPO. So it's actually like very encouraging from my perspective. And in the last 2 years, it's been actually, like if you take out the frenzy of the 21s and the 22s, which was unusual, and it typically happens every 5 years as well, especially in the early stage world. But if you take out the frenzy days, it's actually been a very good kind of, period for people to think about what matters most. How do you deploy your capital and how do you ensure that you're making returns while all the while working with the greatest quality of entrepreneurs? So for me, at least the outlook seems extremely positive over the last 2 years. It might not show up in numbers, but it definitely shows up in returns as far as we are concerned.
Hi, I'm Nitya from Multiples. So just to add to the topic, two, three things I'd like to talk about. One is India has been consumption-driven investment story. So post-COVID, it's been a bit challenging in terms of assessing the consumption world. We've all been talking about K-shaped recovery, and it's been a lot of confusing data. Having said that, the long-term story still looks intact. But which pockets of consumption should you go after? What is going to have a near-term, tailwind? And we're talking about rural versus urban India and so on has been a bit challenging. And combination of food inflation plus the climate has kept us on the edge on looking at consumption stories. So having put that on a somber note, the both financial services as well as interestingly manufacturing has been two flavors. Financial services always has been a good flavor for private equity, but increasingly manufacturing has kind of come in, and that's been a big change from all the 13 years I've spent in private equity. This is, I would say, the most positive outlook on manufacturing that's happened. A combination of both measures taken by the government, whether it's PLI, whether it's China Plus One, whether it's BIS, everything that's happening, it is moving manufacturing for India and manufacturing for the world. So a lot more in terms of newer themes around manufacturing. Arun spoke about more buyouts coming in, and that I think is a secular trend. What has happened is it's moved from ITES to consumer to financial services and to manufacturing as well. So it's spread across sectors. I'd definitely like to call that out. And finally, what is also exciting is larger groups welcoming private equity. We have seen Tatas, Mahindras. We've invested with the Murugappas. So it's a new trend in I would say, where earlier you had first generation entrepreneurs getting in, using private equity as a lever to grow. We've had buyouts. Now we had larger groups as well partnering to enter newer sectors. So it does open up a lot more vistas for us to look at as more capital and dry powder comes in.
Yeah. See, the only system that gets people out of poverty is free markets, where you reward human resourcefulness, human enterprise, human ingenuity. And I think since 1991, when Manmohan Singh first did the reforms, the trend in India has been towards freer markets. And since 2014, we have had a government that had a sense of purpose. It has an ideology which you may agree or disagree, but they have single-mindedly focused with a template. If it's good for India, we'll support it. So a lot of previous problems that we had where there was friction in free markets has been removed. And consequently, you see a lot of opportunities because at the core, you have a highly educated and in many ways a trained and determined workforce. So the catalyst essentially for this to grow is a framework that supports free markets and capital, which is an important catalyst. In the height of Garibi Hatao in India, most people don't realize that if you had income of 100,000 rupees, your taxation, you kept only 2,500 rupees. 97.5% was the marginal tax. On top of it, you had 5% wealth tax. So those days, you literally had zero private capital formation. And how do you start new businesses? You had ICICI, you had IDBI, and you had UTI. These were the only institutions. And clearly, when someone wanted to do a large project, the institution said, bring capital. And the way they brought capital those days was you inflated the project cost, took some money out, and showed that as your contribution. You literally didn't have private equity or any forms of financing then. And consequently, the Indian business scene was dominated by traditional families who had a history of success and who had capital. But that has changed vastly, where people who come from poor families, lower middle class families, by the sheer merit of their idea, their drive, their hunger, are able to raise capital, build businesses that are large, and contribute. I started my career in a construction site. I have a degree in civil engineering from IIT Delhi, and I read Ayn Rand, so I thought I should work as an engineer. And I worked, they made me in charge of a site of about 3,500 people. I was 22 years old, and I really thought I was a really bright guy. That's why they made me. That site was a law and order problem site where no one in the company wanted to go. And so I landed up there, and I see people get killed literally a very short distance. From that, India has progressed a lot. And if you travel around India, I've been to parts of India, right from Arunachal Pradesh to UP, etc., where there was visible poverty. You could see. From that, if you travel around India, there is a clear change. And this has basically come about because in some ways we have been able to harness the power of entrepreneurship of our people. And that is where VCs and private equity people like us form a very, very key component of doing it. And eventually, if you see the success of the United States, where it grew after the Civil War for a 100-year period and became the richest, most powerful country. And the reason was they had a framework of law. After the Homestead Act was passed, property rights were very well established. The reason countries like Brazil, etc., who had far higher resources didn't succeed was because the United States had a framework. In India, we inherited the British legal system. I started my private equity career in the early 90s. I can say that we do have a legal framework that works. It's a bit tedious, it's a bit difficult, but it works.
So if you did a private equity deal and had an agreement, if you had to read that agreement again, that in many ways means you've made a poor choice and the deal is in trouble. A good deal is a strong agreement you write and you never read it again. But then, it's very hard to see what goes on in a person's mind, and you think the guy has integrity, and it turns out maybe he doesn't have. So what I've found in most cases is, the original suit is probably never heard in your lifetime. But so in India, what happens is what I call these ad interim orders have the effect of final orders. But if you got a good ad interim order, you got control of it, it is generally very easy to do a commercial settlement. And these days, arbitration, etc., is good. So I think if the government did a little more in nudging along this legal framework so that it works, a lot more capital will come into the country. And the cost of this friction that the country pays, this kind of uncertainty about property rights, the uncertainty at times that you can establish this, as a country, we bear the heavy price because we could get a lot more money. Then in terms of the trend, Arun was speaking about, I'm pretty optimistic. I won't really bother about, the number going down a little or a little up. The trend is secular. I think India will attract a lot more money. I spent 15 years at the Carlyle Group, and in the initial years, I struggled to explain why we should put as much money in India as in China. I think across the world, in the major financial capitals, from New York to London, etc., it is very, very clear that India, it's going to be India's decade or two. And I think we'll get a large amount of capital. I think the country will become much more prosperous. And for people like us, it should be good times.
Good morning, everyone. This is Venkat here, and I'm the founder of Beta Corporate Advisors. Now, let me take off on the theme of buyouts and control deals right here. Let me try and give you a sell-side perspective because we typically represent entrepreneurs in these transactions. In the last 3 years, we have done 8 control buyout transactions. And these are across healthcare, pharma, IT services, and consumer. If I were to contrast this number with the previous 15 years, it would be the same 7 or 8. So that gives you a perspective of what has been changing on the ground. Now, what's driving this? What is making entrepreneurs choose control deals or buyout deals? I think there are 5 or 6 reasons why buyout deals are standing out these days. The first is it gives the entrepreneur a very unique combination of continuity and change. And this is a very unique combination that's not offered in an M&A product usually. Now, where does continuity come from? In a control transaction, a promoter can choose to retain substantial equity stake. A promoter can have the upside of riding on it and then, sometimes even staying on the PE. We have seen transactions where PE is willing to exit after 5 years. The entrepreneur continues to run the business. The third thing that gives a continuity, which is extremely important in a promoter-owned business, is identity. Now, when you do a control transaction with a PE fund, by and large, your identity is preserved. Identity as a brand, identity as a corporate entity is preserved. And entrepreneurs love that continuity part of identity. The emotional aspect of entrepreneurship is retained. And it gives them a higher flavor of entrepreneurship when compared to an M&A. Now, they still want change. It's not just continuity. They're transacting because they want change. And what's the change that comes? The first thing is you have someone who's willing to push you to aspire for faster growth, higher growth, take a few more risks on the way. The ability of a private equity fund to actually attract talent is well known. I think that's something that increasingly promoters are beginning to appreciate. Last but not the least, there is some de-risking, there is some money in the bank for the promoter. So a combination of all this is making this a very irresistible combination for the promoters. The second thing that's driving this is cap table restructuring. Today, you have many situations where the the promoter who's operating the business is not holding a significant stake. It's usually distributed between several family members and other shareholders. So what the promoter prefers today is, let me clean up the cap table. Let me give an exit to some of the non-operating shareholders and rather, have an institution on the cap table. Third thing, the reality. At the end of the day, any transaction is a commercial transaction. Valuation, terms, and speed. This combination, I think almost every transaction that we have seen, a private equity controlled private equity fund is beating the strategic in the last 3 years. So when a fund is moving quicker than a strategic, when a fund is willing to offer you a better valuation, why would an entrepreneur choose a PE fund, an M&A over a PE fund? Fourth, M&A has seen, especially cross-border M&A, has seen a lot of disputes. And the ecosystem of entrepreneurs is very well networked. Everybody knows what's gone wrong in some M&A transaction. The word spreads. Fortunately, till date, while there have been a few isolated instances of litigations in private equity, it's never been comparable to what we've seen on the M&A front. So all these factors are contributing to increased activity on control deals. 5 years back, for every, the number of promoters who would want a control deal to be pursued along with an M&A deal was 25%. Today, 75% of the promoters who come to us seeking M&A partner want a controlled PE option as well. The second part, 5 years earlier, 6 years earlier, when the entrepreneur wanted to divest minority stake to a PE fund, there was hardly a 10% chance of the promoter evaluating a controlled PE option. Today, that number is almost 30 to 40%. And lastly, and most interesting part, is the entrepreneurs who are willing to come to the table and say, listen, I want a controlled PE deal only. Today, we are working on a very large consumer deal in South India, family-owned business for 50, 60 years. All he wants, the promoter wants, is a controlled PE deal. Either it's a controlled PE or there is no deal, right? So I think this is a great trend. The only other point that I have to make here is the control deals, the buyouts that we are seeing are all larger transactions, check sizes of $100 million upwards. I think a time will come, and it's not far away, when we will see funds with 30, 40, $50 million, wanting to do control transaction. There are already a few of them now, and I think that will democratize it. And let's face it, control deals in Indian context is not new. The first control deal in India in a structured format happened in 1998 when Barings acquired BFL, which is now part of Mphasis. Much prior to that was a group which was doing control transactions in India, not necessarily in a PE structured format. And the gentleman who led that practice, fortunately, who did all those control deals, is sitting right beside me. So we've had a history of control deals, but for everything there is a time, and this time has now come for it to take off.
Saurabh Chatterjee from Chris Capital. I guess one of the downsides of speaking last is I don't know what else I can add.
Sir, let me just change the question, tweak the question slightly for you.
Yeah.
India, we've known its time is coming, as Vinay was mentioning that, looks like this time is right. From your perspective, when you're talking to your LPs, what has changed every time we promise that India this time for sure is going to shine? What has changed this time around? Has anything actually changed?
No, that's a great question. And we get the exact same question from a lot of our LPs. We hear India has potential. When is the potential going to be realized? One, I feel it's an unfair question because, and I asked them, what is the one thing you'd like to see that shows you that India's potential has been realized or has not been realized? And they don't really have an answer for that, right? It's just a feeling they get about the overall market. It's not one metric they've seen. And when say India has potential, India has arrived, they're always comparing it to China, right? And that makes sense because you think in 1991 when India liberalized, our GDP per capita was very similar to that of China's, $600 to $700, $800 GDP per capita. When globalization happened in the late 80s and 90s, that manufacturing could have come to India or China. China took it all. And now their GDP is 12,000, we're at 2,000, 2,500, right? So we completely missed the trick. So, but at the same time, it's an unfair comparison between India and China. China is not a democracy. China can, has eminent domain. They can just take whatever they want, and their model of economic development is also completely fueled by debt. And you are seeing that now with the collapse of the housing sector and things like that in China, where China's the very way that economy is structured is laid out well for them in the last 20 years, but the next 20, 30 years, they're going to see, I think, the downside of that. We are slow and steady. And I think one example of that is, we talked about this backstage, but one of our LPs who's been with us since fund two, they said, look, the way, and he might have been speaking for himself, but he said the way the Western LP world looks at India versus China is the following. China is a 6-lane superhighway, everybody's driving at 120 miles an hour, but there's a storm on the horizon. India, is a 2-lane, bumpy, pothole highway. It's clear weather, but the road is getting better. Now, with all this, after the Russia geopolitical issues happening, the storm, you're at the storm in China, and you don't know what's beyond the storm. In India, over the last few years, the road has been getting better. From 2 lanes to 4 lanes, from 20 miles an hour, you're going 40, 50, 60, and it's still blue skies ahead. So India is slow and steady, but the path is clearer. And I think, when LPs ask, what is different now, I'm like, look, it's just that now, as was mentioned, we have a government that, whether you agree with their political leanings and social ideology or not, executes for the passion. I think the difference in the Modi government and what was there before is that they just execute, right? It's not like Democrats and Republicans in the US where they have a very different view of how to develop the country, where, big government, small government, etc., different views on immigration. In India, the communists or whoever is in power, what needs to be done in India is clear. We need more roads, we need more airports, we need more land reform, we need all that stuff, right? The Modi government has just executed on those things better than other countries, other governments before that. And for the first time, I think we have digital and a physical infrastructure put in place that really provides a foundation for long-term growth, right? Whoever is in power. We've built, 40 to 45,000 kilometers of national highways every year for the last 5 or 6 years. I looked it up, that's at a higher rate than China at its peak, which is, in my mind, everybody looks up to China as a country that executes physical infrastructure on a scale that has not been seen since the US started building highways post-World War II, right? It was incredibly gratifying to me to see that we are beating China on this very critical metric. So national highways, rural roads, we now have 97% of our railways are electrified. In UK, the number is 40%. In Europe, the number is 60%. So on that very critical metric, we're ahead of Europe. The number of airports is 2x. We've all seen news about Air India and Boeing. So on all these critical physical things, we've now moving at a pace that has not been seen in India before. And then obviously, everybody here knows about the digital infrastructure, right? Aadhaar, UPI, etc. All of this really brings people into the financial ecosystem. The fact that direct welfare transfers are now happening direct to bank accounts, and people don't have to walk 5 miles to the post office or to the bank to get their money. That just just takes the friction out of the system. And once you bring people into the financial net, you get more. People can take loans, there's credit, there's debit cards. It allows people to, at a very fundamental level, at the farm. Now, instead of having to have their kid work at the farm, they can send him to school. And that just creates a step change in the future of that family and hence the future of the country. So I think and it's reflected in the macro numbers as well. The rest of the world is languishing. We're at 6.5%, 7.5% GDP growth. Inflation is under control. Foreign exchange reserves are holding strong. The rupee is fairly decent compared to all the other economies. So when people say India has potential, when is that potential going to be reached? Look at the numbers, the potential is being reached. Like, what is that magic number that you're looking for? But if you look at all the metrics, look at the high-level metrics, look at the lower-level metrics, look at the system that we put in place, we are now, I don't think a lot of global LPs, investors realize what is going to happen in India over the next 20 years. India over the next 20, 25 years will see a level of wealth creation and development that has not been seen in India's history for sure. And it's not going to be quite China was in the last 20 years. We've not averaged 10% GDP growth for 20 years. We're not set up for that. But it's going to be the world's fastest growing large market for the next 20 years, and tremendous wealth will be created across all levels of the ecosystem for entrepreneurs, for individual citizens, for investors, for elements. And so it's the time to board that train because the bullet train is.
See, if you see, there are two broad trends. If you looked at the OECD countries, corporates, they have to give a better product, a better service year after year and grow their earnings. And India is very well placed to do that. It's not just IT or IT enabled services. It could be generic pharmaceuticals, it could be garments, it could be some kind of niche manufacturing. That roughly constitutes probably around 20% of the GDP. The other 80% is where India has struggled. And that is where, my colleague on the panel, what he said. This government, in terms of execution, has managed to reduce the friction. It has created a kind of infrastructure that will help grow. Because for a large economy, India has got the largest percentage of young people. So you'll see disposable incomes rise, you'll see propensity to consume and save increase, and that acts as a positive catalyst. So just when the US grew for a 100-year period, and you have these huge multinational corporations that came out of that growth, same way you'd see a lot of Indian companies coming literally out of nowhere and become very large. I started private equity when I started private equity in '93, I was more Forrest Gump than a private equity guy. The first deal that came our way, Johnson Titans, the Bangurs were negotiating for 8-9 months to buy it. The only idea I had how a company was bought was what I read in Warren Buffett's letters to shareholders. And I studied the balance sheet. I had no idea you had to do a due diligence. And it was Rajendra Aria's money, so there were no cell phones. I called on a landline. Kaisa hai? Acha hai. We bought it. We paid money in 3 days. There was no one to run it. I went and ran it as CEO for a year. We, of course, made tons of money on the deal. We got excited. So if you see, I've been a mid-market guy, single or double-digit million-dollar checks. A lot of those businesses have become multi-billion-dollar businesses by growing. Exide, Prism Johnson, a lot of businesses have become. So really, I think, you'll see a lot of companies become multi-billion-dollar businesses, which have a sound foundation and are able to exploit these tailwinds, either in this whole outsourcing wagon or the theme of domestic consumption.
Gautam, the one question that has changed since we are just wrapping up a fundraise, the one question that has changed is huge concern on exits. I see far less questions around that. I think last few years have been great for exits in India. We also saw the chart that Arun put up, but I was looking at the last 3 years IPOs as well. 65% of the companies that went IPO and raised money were PE-backed companies, either as minority or controlled. So the very fact that so the exit question, which was the big question for the last decade, has definitely come up. What is that one question that has not changed at all? Can't understand valuations of India. Still. So I think that continues, and that speaks to what a lot of us here are positive about, because the potential for the next 10 years is very strong, and hence, despite the valuations, you do make IRRs and good returns here. But that's a question the world still grapples to understand.
Nithya, you touched upon that exits part, that question has changed. What do you think has contributed to that change in questioning, and is it likely to stay?
See, two things. One is of course public markets, but I do believe that one needs to, because a lot of money. I mean, look at the DII money, right? I mean, it's funny to see the chart. 10 years back, it was the reverse. 20% DII, 80% FII. Now it is exactly 80% DII, 20% FII. So that's giving a lot of stability and ability to go out and close your IPOs. Having said that, the bar for having a well-listed company on which you can execute exits even after it's listed, you need to be cautious about it. I think so. One is public markets, acceptance of non-promoter-led, private equity or distributed shareholding companies into the market. A lot of success stories around that. Second is this whole ecosystem developing, from growth funds selling to larger global funds, and the P2P has also taken off a lot. So both of these have allowed exits to happen. Otherwise, the earlier charts that we used to put out in our second fundraise used to be how much money came in, how much money went out, and how much money is stuck for 7 years and 8 years, and how life is going to change. I see that discussion has completely come off. So I think that is here to stay, and the amount of dry powder which is further coming in, right? the talk of all the, well, it's difficult to put a number. Earlier, what used to be India's allocation of maybe 10-15% is definitely moving to the 20s. So a lot more global money is definitely going to hit India. And that I think is here to stay. So this whole ecosystem of P2P as well as public markets is helping this question to go away.
Can I just add a point on public markets, right? I think it's been great in terms of giving exits to PE investors. There are two other trends that I'm seeing. One, there are sectors, subsectors, and sectors where the gap between public market valuations and private equity valuations have become very diverse. Let me give you an example of defense. Let me give you an example of electronic manufacturing services. These are two segments where the listed multiples are all in excess of 40 to 60 times, right, of earnings. Now, even a 100, 200 crore company that comes to us to raise private equity is finding it difficult to kind of justify why they want to do a private equity deal because there is no way a PE fund can be anywhere close to those numbers. So as this gap increases, it's quite possible that some sectors might move out of the zone of private equity investors because it becomes difficult to transact. And let's also remember that this sector of defense, aerospace, EMS is a huge growth opportunity. We've had at least 3 opportunities where we've had term sheets from private equity funds, but the promoter refused to take it, went public in 9 months at 3 times that valuation. Right? So this is absolutely, gaps too large. Second thing is we notice that there are companies today which are able to hit the public markets much earlier than they could have done earlier in terms of maturity. What this is doing is it's actually reducing the number of later stage private equity rounds. So one will have to wait and watch whether the pie is likely to shrink at one level because a lot of companies prefer IPO to private equity. And we will have to wait for the numbers to come out because today, at least in our own portfolio, we've seen 5 or 6 companies which potentially could have done 2, if not at least 1, if not 2 more rounds of private equity choosing the IPO.
See, that I'd like to add to it. See, I started as a markets guy. Markets tend to be irrational both on the way up and on the way down. Today, if you looked at the China listed space, there are companies, $1 billion market cap, $1 billion cash in the bank, $1 billion revenue, profitable, and the market cap is $230 million. And in PE, there are 2 kinds of mistakes you could make. One is you do a bad deal and you lose money. The second is you miss a good deal. And in PE, you don't get punished if you miss a good deal because capital is limited. You do good deals, you do a 3 kind of point, your investors are happy. You do a bad deal or 2, then 3 becomes a struggle. And the challenge in this manufacturing sector is a lot of those companies have poor margins. They struggle on profitability. The return on capital is low. But the public markets, for whatever reason, like someone likes a Rothko painting. Painting, then yes, my 80 crore would do it. But it goes for $100 million. So, and unfortunately, there is no formula that tells you this valuation is right or wrong. Because valuation is probably a little more an art than it is a science. So as a PE person, if you want to have a good and consistent track record, you got to stick to the discipline. Now, if you are a hedge fund and there is this short-term trend, you would give a lot of money and say, okay, I do a pre-IPO, it's going to have a 50% bump when it lists, and I will sell it, which is what fuels the market. And this trend of domestic money going in from provident funds, etc., is supporting the market. Now, what happens in a free market is you'll get a lot of issues like this. And at some time, it will correct. Now, whether it will correct in 6 months or whether it will correct in 6 years, very hard to predict. You don't know what it is. But I worry about the fundamentals of some of these businesses. I can tell you I was on the board of a great listed company in Carlisle. We had a 15% stake, and there was a manufacturing business, specialized manufacturing business, that came about. And I thought maybe he'll ask this company to buy it. So I took the founder there because there was a certain motivation. And the CEO of that business told him, look, I won't buy this for scrap value. He just didn't want to buy it. And in this whole run, the company has a market cap which is 30 times more than what he wanted at that time. So there is, at one end, you could say there is a certain irrationality about this whole manufacturing sector. Or the other thing, as in the trading room, we used to say, you may be wise, but the market is right. It's interesting. The dynamic is interesting. And there is one deal Venkat and I worked on, and he would have settled for about 20 times more valuation he got from the public market. And he struggled to get PE there.
I just wanted to touch upon, like to add to what everybody's already said. Two things, which is one, which is a societal change, which is also happening. We have an India Mart with a 50% promoter controlled stake coming into IPO. You also have a Flipkart where the founders have 5%, and it is just as acceptable. Earlier, everywhere you had to be in control. You had to be seen as the owner. It was a multi-generational thing that people thought about as creating entities. And in those kind of contexts, how you raised, managed, lived with capital was a very different context from what it is today. And that by itself is a structural change that has come into society. The second is like the way that we are looking at governance. Imagine the change in governance of boards of companies between the late 90s that he was referring to the boards that exist today. There is a huge degree of empowerment that is actually like happened in there. So this with these two, there is actually like an oversight structure and a societal change which encourages people much more to be in a world which is actually like where you're not expected to be continually transacting, right? You can be a founder today. You can actually like sell out to a buyout firm, or you can sell out to an M&A kind of a transaction. It's fine. And that acceptance is also kind of like driving the fact that many people don't see themselves as successes or failures purely defined by, I'm a business house which has lasted for 150 years. You can be that. You can also be a founder who's created a great business and then exited from that. And in that kind of context, it has become easier for investors like us to have conversations around exits. Just a conversation, like in earlier days when you asked a founder, what is your horizon? How do we think about exit? And there were a huge number of exit clauses. And most of us knew none of this was true. When we signed agreements, some of us thought like whatever you do, like what happens is what will happen, right? Like we'll figure that out in some way and we'll struggle through, muddle through, and then we'll figure out. But now there is a reasonable degree of adherence. There is a reasonable degree of how people are, of conversations which happen, which say, like what? This is where I am going. As a founder, there have been like there are people in my portfolio who say, I'm IPO bound. Don't get in my way. Right? Like I will give you information. After a few years, you might talk about board seats. In 2 years' time, you need to step off because I would be like, like there is all these listing norms and so on and so forth. So they're having those conversations openly. And it's a good conversation. It's a two-way conversation. It's not one-sided either ways, I'm saying. So in that kind of a context, the power of there was this power equation between investors and founders just significantly changed, and it's become a conversation. That by itself is like very, very empowering for an ecosystem that is growing. And I think that's also a big change, which will kind of attract greater and greater capital into this country, which can absorb lots and lots of capital on its way to becoming 10 trillion or like per capita GDP becoming even a mid-income kind of 5,000, 6,000 kind of country. We can absorb a lot of capital, but to attract that, you need these kind of structural changes, which I think like have been set in place over the last few years.
I think the one area where PE, I think, hasn't done a good job is probably persuade the government that what PE has done is a vital job. If you take Chris Capital, if you take Carlyle, you take Blackstone, apart from money, these private equity shops help the businesses run better. And when they run better, you have greater profits, which means greater taxes. You create greater employment. and you create all-round prosperity. So it is not just the PE person who's making money, but the country as a whole benefits.
Thanks for that perspective. Switching gears, Saurabh spoke about the storm, the geopolitical scenario. Nitya, looking at you now, what are the macro trends which are standing out? And how is multiples tweaking its investment and exit strategies around it?
Yeah, so at multiples, I wouldn't say we are tweaking. We have, my private equity is a portfolio business, so we have always thought of it as saying it has three planks. There is investing behind the big ships, which is little younger companies playing to big ships in the economy. In that zone, we continue to play. So we have looked at green as a big shift, which is happening, and started that journey with e-mobility, which we invested with Morikappa Group. And there's a lot more happening there. There is recycling businesses, there is green hydrogen. So there's a lot of activity, and we do hope to build on that whole theme. The classical theme of growth continues to play out. So whether it's heading towards manufacturing, again, consumer or financial services. So all of that will play out in our growth zone. And finally, Venkat spoke very well about the whole buyout really panning out. And here we are seeing two themes. One is private equity starting businesses as well. So platform transactions. We've had a particularly successful one in our housing finance entity, which we built up from 2015, and that's given more confidence for us. And just to add to this debate on some companies are more suited to public markets and some will come more towards private equity. I think one thing that has gone up is confidence of private equity to really execute transformation in companies and what loosely we call as value add. That has definitely stepped up a lot. And that's a question that comes from LPs as well. And with that confidence going up among all the investors, our ability to look at what we would call good companies, but not great companies. Great companies can find their way to the public markets far easier. It's a story which can be understood well. But the opportunity is also to pick up the good companies. As Shankar said, set right a lot of things. Power the possibilities even more by attracting better talent, improving the governance, and getting the data systems right, improving the technology. So I do feel a lot of that will play out in the growth theme as well. Transformation stories, not just I picked up the best company in the sector and the best entrepreneur sector, and we are going to write that and take the thing. So that I think little bit of change in the way we think of entering transformative stories. And on the buyout side, both platforms as well as other than entrepreneurs also wanting, buyout private equity, we also see larger groups shedding businesses. We bought out the animal health business from one such larger group. And increasingly, selling to private equity is becoming easier as well because if you're putting out an M&A, you're sharing data with the potential competitor of the business, and if that deal doesn't go through, you're in a tough spot. So a lot of larger groups or sharing businesses are finding private equity to be good buyers. So I would say these thematics would kind of continue for us.
Just on that point, how does macro sort of affect our investment strategy? LPs ask us that as well. And I think we tell them that, look, we're a micro business, we're not a macro business. And in fact, when LPs are super excited, because right now on the macro point again, India is the one shining star on the global macro stage. And we tell them, look, don't invest in us or in India because the macro is good. Because in a private equity construct, it's a 10-year thing. By the time you write your check for the fund, the macro will have changed. By the time you write your last capital call for the month, the macro will definitely have gone up and down. So don't invest in India because the macro is hot right now. Invest in India because if you think we have the foundation for long-term growth, like I said before, right? But at the end of the day, we view ourselves as micro investors. Whatever is happening in the macro, we've got to deliver our returns. That's why you get paid the management fee. That's why you get paid the carry, right? So you can't take slow macro growth and this and that and excuses to deliver slow returns. Obviously, something dramatic and once in a generation like COVID happens, then maybe you have it, right? But in general, nobody cares. LPs don't care. You got to have the returns, and we view ourselves that way as well. If you're micro investors, you are looking at not the pharma industry. You're looking at the domestic formulations part of pharma, not just the domestic formulations part. You're looking at the chronic segment. In the chronic segment, which therapeutic areas are doing well? Within that, which drugs are have more competition, higher margins? So you can deliver returns even in a higher valued market, right? LPs constantly talk about the high valuations in India. So the way to counter that is, or the response in my mind is, look, saying that the overall index is overvalued, that's a very macro high level thing. You've got to go 3-4 levels down, and at that level, you can always find a company that is at the right valuation, at the right stage of its growth. And look at the overall market is $50 billion. We're looking to deploy at Chris Capital 600-700 million a year. You can find in a $50 billion market, in a $3 trillion economy, you can find $500 to $600 million worth of good investments very easily. That's not a problem. And then what did you mention, right? The value add part. That's become a big driver of differentiation. And in a slower growth global economy, in India is a highly intermediate market. You can't really find proprietary deals, right? Every deal is an auction, every deal is bid up. In a slower growth market, in a highly intermediate market, how do you get to your benchmark returns? If the growth is not there, prices are bid up through value add. So you've got to find these companies that need help. And as been mentioned by several people on this panel, entrepreneurs are now more open to accepting private equity as a value-added investor, right? So you go in there, you help the company grow their margins, you help them with supply chain, you help them build up their board, their N-1, you help them with the board acquisitions. That's a skill a lot of smaller targets of private equity firms, that skill they don't have. They're great at growing revenues, but not great at identifying M&A. So you do all these things, and that helps you sort of add the value, that helps you defray the valuation question, that helps you defray the macro question. And no matter what is happening in macro, don't worry, I've put in place a system and we have a set of skills that will help us deliver value no matter what is happening on the macro, because we operate at a much more deeper level.
India is a large market. In Sanaka, we've seen 1,700 deals. We have done 6. So you see a lot of rubbish deals. You see a lot of good deals where the valuation doesn't match. So I don't think selectivity is a problem. So when I started my career in the early 90s, the initial companies we bought, we actually went and ran it. And we were a bunch of guys. So at the end of Second World War, there was a bunch of 10 guys who was led by a guy called Colonel Scott, who sent a telegram to Henry Ford and told them, we are a bunch of really bright guys. We can change Ford Motor Company. And just on an instinct, Henry Ford hired them. And these guys used to go around asking questions. And they did serious value add to Ford Motor Company. 2 of the 10, R.J. Miller and Robert McNamara, became CEOs of Ford Motor Company. So what I did when I went to have the investment, I was 30 years old. Everyone else was in their 20s. And they were either CA bankers or toppers out of IIT and who had business sense. And we went and ran an Excite on one engine, 2% antimonial lead. I remember we saved what was 3.5 times the net profit of Excite at the time. So I think being this value add brings a new perspective and brings a lot of skill. A lot of these large and boutique consulting companies help. They hire specialists. Chris made an investment in Gibbs, and I know they got a very good guy. They grew the business. And that is the kind of thing where PEs in India have made a difference. And it doesn't matter whether you have macro tailwinds or headwinds. If you have tailwinds, you make a far higher return. But if the fundamentals of your business are good, it is reasonably resilient to give you the returns.
Anuradha, 2023, investments in PhonePe and insurance decor. What is the new theme towards B2C in fintech that TVS seems to be pursuing?
I would add Sarvakram to the list, right? So as you think about it, this is an investment. It becomes very easy for us to kind of like lay out our investment philosophy. On the one hand, end of the scale is a company like PhonePe, tens of billions of dollars in valuation, huge amount of scale, running practically like on the, like with 48% market share in the UPI transactions market, building something which is close to a, like a monopoly. So it's a very different kind of a way that you kind of like look at them. And, like we had a 2,000 crore fund which invested in that as well. Right. So on the one hand, you have that kind of investment where we are still continuing to look at and purely tech-led, 100% fintech, which is like, like where the tech is actually like the DNA of the company. So we look at like that kind of both the stage as well as, like the kind of founders, the kind of backing, the kind of scale that they have created. We continue to look at late stage investments like that. Then comes insurance, they go, which is a little bit more in terms of classic growth, as we call it, which is about like increasing penetration of insurance and using tech as a means of getting deeper and penetrating deeper and deeper into the advisors ecosystem and helping them actually, sell products in a much better way. So it is no longer about like, like in confusing people with like, is insurance an investment tool, a savings tool, or is it a risk management tool and so on, right? You have a way of communicating things well in a way that people understand the product and buy, right? And tech enables that very well. So it's a tech-enabled product. They manage about 100,000 advisors on the ground. And these are people who are in all kinds of markets. So for them, tech is an important thing to help manage the system. It is tech-enabled, not tech first. So unlike PhonePe, this is not tech first. It actually relies on people talking to people, but enables them with decision-making tools as such. And then comes Sarvagram, which is a rural NBFC, looking at providing loans to households. And, like interestingly, they don't have a product. They don't go and say, I have a gold loan for you. They say, like, but help me understand your household and what's your loan need. The loan need might be 50,000 rupees, might be 3 lakh rupees. And then they tailor products according to the needs, right? And how are they doing this? They use a lot of like data which is available from the environment. Funnily enough, they fund rural Kirana stores on the basis of GST that actually like receipts, which the Kirana store himself might not be a GST registered guy, but he's supposed to create and sign off on a receipt for the guy, the distributor who's sitting above him. So there's a lot of data which is available. There's a lot of banking data which is available. There's a lot of transaction data which is available. Dairy farms supplying, giving a parchi, putting out an SMS saying this is the amount of milk that we collected, and here's like actually what we will put into your bank account, right? That's what drives them. So this is a company which relies on data which is available around, but now has no technology in there. So we're looking at fundamentally 3 things. And we invested at a stage where there were 250 crores in AUM, right? And that's what we call our venture growth kind of a model. So a venture growth, a classic growth, and a late stage. So we are agnostic on that. What we are looking for in here are 3 things. People who deeply understand their customers and the customer segments that they are serving have demonstrated phenomenal ability to execute and build businesses in there. And our own ability to actually like, kind of define and construct our capital availability around them. So in a Sarvagram, our shareholding will be much higher. The capital deployed will be much higher. In Insurance Deco, it will be like, a classic 2-stage investment process. In PhonePe, it'll be 1 round and that'll be the end of it. So we're comfortable to know how to deploy different degrees of capital. It could be a 50 crore check, it could be a 300 crore check, and we are able to manage this very well. The thing actually that TVS Capital is a little bit different from many other PE funds around is that we have domestic capital 100%. And the composition of that domestic capital is actually family offices, HNIs, and institutions. 2/3 of our capital is family offices and HNIs, and only 1/3 is institutional. So we actually like look at raising capital domestically and building returns domestically as well, right? So these are people who understand these markets very well, and many of them co-invest along with us. So when the fund writes a 200 crore check, there's 100 crore which is coming as co-investment from our community of LPs who are local. And that is something that therefore, like, gives us a greater ability to deploy a larger amount of capital. That defines us. So we're looking at financial, like continuing on this path of financial services, different stages, and ourselves actually like giving, and like different kind of flexible checks, as we call it, to suit the stage. In Sarvagra, the capability capital that we add is very different from from how we interface with insurance. They go PhonePe, we leave them. Right? Like there's little value addition that we can do. The one thing that we've helped them do well is to navigate regulatory pathways. Right. So the way that you kind of like engage with people and add value changes, and that's a skill that we're also learning in this plan.
Shankar, we are heading to elections. Not just us, about 70 plus elections are right on the horizon. What are the things that we should be looking out for, and what is our wish list from the future that is to come from a BE perspective?
See, the key thing is, if you see India, and at one time, I think about 25 to 27% of the global GDP came out of India. And that was a time when in India, truly free markets prevailed. Trade was free, entrepreneurship was there, financing was available recently, and we had the example of the relative per capita GDP of India and China. You see a country like Mauritius, their GDP is a huge multiple of what the per capita GDP in India is. And they're essentially, it's majority Indian origin, people essentially from Bihar and Tamil Nadu who are taken as indentured labor to work there. And the reason it has become prosperous is you have a framework and a system with far less friction in doing business than that is there in India. I think this government has done a good job in making it less, but I still think there is a long way to go. For example, take uncertainty of taxation. Every time illogical, outrageous demand is made, there is a cost the country pays, because you have a process where eventually nothing comes out of it. But then, commerce doesn't flourish because you have this kind of sort of Damocles that hangs over you. When you want to set up a unit, there is a reason why the southern states like Tamil Nadu and Maharashtra, etc., are economically faring much better than certain other states. And this comes down to the factor of friction. I think the one good thing is those days of coalition government and uncertainty on the political side is gone. I think political corruption is virtually non-existent, at least at the central level. It is not there. I think the bureaucracy is still a bit of an albatross around the neck of people. But because I think people see clarity in political continuity, I think things are getting better. But I would say if I were in the government, I would do everything to remove this friction that is there, this uncertainty that is there. I think there is some kind of a cost the government would pay, because there would be some dishonest people who get through the system. But I think the tax lawyer Boris Kaka was saying that there should be a bill of rights for taxpayers. That is a bit of an extreme thing. I think certainty is what private equity and VC people want. And if this government could get certainty in various aspects of our life, whether it is implementability of agreements we sign, or taxation, GST, I'm sure a lot of portfolio companies would have received all kinds of GST notices. I think if all of that is it'll help greatly.
Can I add? I think from a private equity, India private equity perspective, one long-standing ask, and I think we've all spoken about how Middle India is going to invest more. We are seeing that money flowing into the capital markets. It would be wonderful to see that money flow into India private equity as well. Anuradha spoke about that, and I'm sure from a 2,000 crore fund to build it to a much larger fund, you need a lot more of that. So that's been a long-standing demand. We have seen two steps forward and one step back more recently. From the regulators coming in with a hammer at the side of, I'm sure, as Shankar said, somebody would have taken advantage of the local EIF regulations, and that's brought the hammer down. So it's a little bit on one step back, and I hope it gets back to two steps forward very soon, because it's channeling that money, whether through other institutions or directly in, and helping that money get to institutional investors like we represent here, would really help. India money fueling India businesses would be great. So I think that will be on my list to go.
Sir, moving to you, is the environment right for exits? And from the Mankind IPO perspective, if you could just shed some color around how is exits looking now from this stage onwards? No, as we've covered already, right? Exits are not a huge concern in India anymore. We have this one chart in investor presentation that shows exits in India for the last 25 years. From 2006 to 16, it was sort of $2-3 million a year, just flat. And then, from 16 onwards, there's a significant spike, 25-30 million dollars, and a little bit volatility, but the picture's dramatically changed. I think the Mankind example just shows, I think what Nithya mentioned before is that it might sound simplistic and trite, but if you invest in a good company, you will get a good exit, right? And Mankind is a perfect example of that. We first invested in Mankind in 2008. It was like 200-400 crores in revenue. We exited in 2015 at 12x ROI, invested again in 2017, and now had a partial exit. Obviously, at lower ROI because the company is much bigger, but it's just a classic example of partnering with a company that is open to having you as a value-added partner. When we first invested in Mankind, everything was going great. The company is growing at 25-30% a year. So candidly, there was not much value that we could bring at that point. It was just investing behind an incredible entrepreneur and just letting them run. The second time we invested, because the company was much bigger, growth had slowed. They were not growing at 20-25%. They were growing at sort of 15-18%. But the difference that we could bring was cost optimization. So Mankind has always been a price warrior. So their EBITDA margins have always been a little bit lower than other folks in the industry. But then we went in and said, look, you can still keep your price warrior status, but there's a number of things you can do on the cost optimization part that can really help take your EBITDA margins from the 18-20% level or 25-26% level we see now. So that the second time we invested, we got in, our value addition was a lot more. And we had set up our portfolio operations group in Hansen at that time as well. So that was also a test case for them. And they did a fantastic job. We worked with the company, we brought in McKinsey for certain things, did some things on our own, the company did some things on their own. And a lot of it is not super complex, right? Fixing the size of the packaging, the difference between each bill on a blister pack, right? Why does it need to be that much space? Why can't the pack be smaller? Optimizing the supplier base, having blind reverse options, things like that, really help them move up the chain in terms of EBITDA margins. And you had, a fantastic IPO. And I think on the IPO front, I think we've taken 12 or 13 companies public now, including Mankind, and have a bunch of companies in the portfolio that will go public in the next couple of years. I think one thing we've learned is you've got to leave some money on the table for the next guy. Right? You cannot price the IPO to perfection where all the rents are being captured by the people who are selling in the IPO. So that's a discussion we had with the entrepreneur, and they understood as well. They were also selling, but they were fine, selling that stub stake at a lower valuation, because that means that, that 90% still continue to hold will be held at a much higher valuation. Because, and folks will know this much better than me, you will have if you don't have that first day pop, then that company gets a little bit of a stink, right? If you don't have that 20-30% first day pop, then it's not a great company. So we decided, look, you have to have that first day pop. Let's leave the money on the table for the next person. And then once you get that good reputation, now Mankind is up 50, 60, 70% since IPO. And that actually is not only for IPO exits, that's for every exit. We've got to leave a little bit of money on the table for the next guy. That will create that excitement. And so when ChrysCapital brings a company to market, people realize, there's still some juice left in this lemon, right? So we sold Infogain to Apax. That was a marquee exit, $900 million exit, $500 million, $50 million proceeds for the fund, return fund 6. But Infogain has done really well for Apax in the last couple of years that they've had it. So when ChrysCapital, the reputation we try to develop in the market is when ChrysCapital brings the company to market, there's still some runway there. The next person can still have a lot of growth.
and that helps us get our exits and so on and so forth.
Venkat, we touched upon the whole fact that FII money versus domestic money. What is the future? What is the color of money that we are likely to see going forward this year?
I think we'll see a good, healthy mix of both. I think there is, Anuradha mentioned, there is a lot of, appetite for domestic money. Family offices are chipping in, ultra HNIs are chipping in, institutions are supporting, of course. I think from a sell-side entrepreneur perspective, gone are the days when, entrepreneurs used to be enamored by foreign capital, right? I think there used to be a perception at some point of time that foreign funds would pay more valuations, perhaps add more value, and hopefully create more value. I think that phase is gone. I think it's a much more mature market where entrepreneurs have far more method to selecting a fund. And obviously, valuation, I don't think they really look at whether it's domestic or foreign money. I think obviously the base criteria is, the valuation, term, structure. But if you drill down further, I think they do look at the brand of the fund, they look at the value add potential, they look at the culture fit, they look at chemistry, they also look at the track record of the fund, right? And exits and disputes, if any. And a lot of entrepreneurs today also have second generation members in the business. The second generation members usually have a very different academic exposure. I've seen situations where there is an investment banker, family member sitting on the table on the opposite side. I've also seen situations where there is a lawyer sitting on the opposite side who's not a lawyer but a part of the family. So a combination of all this ensures that decision making is a lot more thoughtful. Of course, when there is an existing private equity investor, it's a Series B or it's an exit, a few other criteria also come into the picture. There are some sectors where I think there is a preference for domestic capital. Defense is one. The liberalization in FDI has not really enthused the entrepreneurs to go for foreign investment. There is some apprehension. They are much more comfortable in defense with domestic capital. Otherwise, it's a fairly network community. I mean, you land in a city like Hyderabad and you're doing a deal. The entrepreneurs are so well connected out there. In the first discussion, you have a list of funds that they want to deal with and the funds they may not want to deal with. I don't think it really matters, with regard to the color of capital. We moved away from that phase.
That's very interesting. Gautam, can we go for a couple of audience questions?
Sure.
Yeah, maybe one last one within the panel.
I'm good to start with the question.
Sure. Any questions?
Yeah. Good morning, everyone. Extremely, insightful things to take away, especially for me being a market participant. I think fundamentally, like all of you all put together the fact that, India has a lot of good tailwinds in place, and maybe it's just up to the youth and maybe people, participants who realize it. I think one common question that we all face is with regards to valuation. Myself being on the investment side and, providing startup advice or, just talking about financial markets in general, I think that is a question that I get faced a lot as well, especially at times when, maybe a premium payment company is facing a lot of troubles. Another tech darling, maybe if it would have been listed, they would have faced troubles as well. So I think markets being a lot of behavioral finance metric and, they take a lot of historical precedence. If these darling IPOs that have happened of startups and, these exits and PE control stuff that have happened, if they don't actually end up realizing the potential, I believe a lot of startups that got listed, maybe 15-year-old companies, they're still sitting at flattish kind of, market prices. I believe then it becomes very difficult for that public market rewarding to continue to happen, because the historical precedence has not been set. So my question or my curiosity would be like, how do we all go about, ensuring that value, like Saurabh sir mentioned, maybe leaving some, money on the table or, ensuring the next guy pays well. But just for the TAM to be actually realized, or for that utopian story to actually get realized? What is it that even post exits or with minority stake, is it for the public markets that they continue to maybe value a startup? Well, I know it's a long question, but if something on that line, maybe a Nike or something like that.
See, no one in the universe can guarantee outcomes. You just can't guarantee outcomes, and leaders who try to guarantee outcomes destroy the countries. And the same thing is true with companies. You invest in a fundamentally good company and good business. The valuation is an outcome of that business being intrinsically good. At a macro level, markets go through cycles. But if your business is good, over a period of time, your return will be very good. If you left money on the table, it'll help the process. But the fundamental starting point is the business has to be good. In the venture space, there are great companies that come out of it. And a lot of companies are more dream than reality. I had one business idea which I thought was terrible, and he wanted a high valuation. So I told him, look, you're telling me, give me $5,000 and I'll give you $5 million. So it can't be a bad idea, but you're saying I'll get $5 million in heaven. So now I want to understand the mechanics of it. So if it is like that, the companies are more promised, more hype, the companies will suffer over a period of time. And you have to go back to the fundamentals and fix it. And if you can't fix the fundamentals, it'll go away.
I think, look, you just got to have respect for the public markets. So, venture capital, private equity, in some cases, they can invest based on future, and this is going to happen 10, 15 years later. So let's put the valuation now. I don't think the public markets think that way. You've got to bring a sustainable, profitable business model that is profitable at the unit economics level, profitable after corporate costs, not adjusted EBITDA and multiple layers of adjusted EBITDA. If it's profitable now, if it's a good management team, if there's a clear path to growth, you will get the valuation. And maybe some of these companies are overvalued in the private space. And so when you go public and sell to an Indian, more and more obviously DIIs, and Indian investors who don't believe in future fairy tales potentially, you either don't go public or adjust your valuation expectations accordingly. But I think it's just having respect for the public markets, public market investors, if they're looking for a company. We have one question here.
Good morning. I'm Amrita from Cap 70 Angels. I would like to understand, as PE, when do you go for exit? It is said that investors look return in 3 years for like 3 times multiples. When do you all decide to exit the PE fund?
I think we define exit as a journey rather than a destination in a manner of speaking. Generally, the horizons are what we have seen is more of 4 to 7 years. But also, it's the reason I called it a journey is the company has to be ready, for that exit as well. And one is, of course, the scale. The other is typically sometimes the kind of stakes that we hold are pretty substantive. And whenever there is a change of such substantive stake, there's a change in the philosophy of the shareholder as well. So the company has to be ready for taking that change because most of us are very involved shareholders. So there is a alignment with the underlying company, which needs to then realign with the new shareholder coming in, even if it's another private equity or so on. So it's context specific, but I would say that if you're looking at a growth company which is on its path, it would typically be in this 4 to 6 years. If you're building out a company, it's likely to be longer. But it's context specific and it's in this zone, and the company has to be ready. And as Saurabh said, the company has to be ready for the public markets as well. I think equally, the company has to be ready, not just financials, management and board, so many other things to be ready to take into the public markets as well.
We'll have one final question.
Thank you. I'm Michael Liu. This was great event, a lot of insightful takeaways. As a MBA and PhD on finance from US and China, I have one comment and one questions on PE side. One comment is how you look at the India opportunities. I have been in India 4 years, staying there, and my home base is California, Newport Coast. The India opportunities mean driving force of global economy is going to shift over to the Indians. For the four reasons. If you look at India, easily to describe the four numbers: 1.4 billion populations, 27 years old, the youngest age of a major global economy. Third is 32% urbanization. Fourth is $2,100 per capita GDP. So no mistake, each global economy driven by urbanizations. People say modernization, urbanization, industrialization. Down the end is urbanizations. You look at on another side, China. There are no emotion. China having two sons. Urbanization rate reached 80%. If you're looking back to the US, 1929 to 1932, recession. Before that, called a Gilded Age, golden time. Why? What's happened? Urbanization freezed, overcapacities. 1.4 billion populations, consuming powers, driven by urbanization, finished. Land, apartment decoration, building materials, everything overcapacity. That is the sun. China's speed slowing down. Chinese government say, instead of looking for speed, we look at quality. On the second part is just like a second said, free economy, free market. Free market is not compatible with controlling politicals. Free market is compatible with the democracies. So one side is you want economy fast, another side is political reform is way behind. So right now, Chinese, each government, they have a government-owned business, the corporations. They're grab opportunity competing with private business. So that is going to hurt for the long run. Sure. Thank you. I know the event is running short. So opportunity definitely over here for the last probably 10, 20 years. For the questions, because we are mid market, PE for work in the US, China through Hong Kong. And we came India with the goal to bridge China, India for manufacturers. Because market is big and know-how and technology in China. So for the PE side, I'm glad to see India is also making progress. A lot of countries, people talk about PE only on size, on things, instead of running the business. PE have to run the business. If PE have to run business, my question is number one, where to find talent? And how government, one party say government have to look in, PE help the business run better. But even the US, when KKI start in the 60s, because typically when economy has fast growth, PE involved, PE start. People thinking about the Barbara at the gate, they're barbarians. No mistake. Because once they get in, they're going to sell the assets. They're going to cut the people. They're not nice people. Because they're going to change the company's culture from the family to be the financial number driven. So if that is true, how government, democracies. So how government will look at? That's my second. Number one, where's talent? Right. Number two is how government look at. Number three is PE typically leverage on the LBO started from a long time ago. Leverage about. So how the debt market in the India to support them? If there are no if there are no junk bond, PKI cannot grow that fast. So how about debt market in the India to support the PE practice? A couple questions on PE side. Thank you.
See, I didn't hear your first and second question, but I can answer the third one. In India, under central bank rules, you can't take leverage to buy a company. It is not allowed. It's, of course, I think a law of unintended consequences. I think the original central bank intention was to make sure people don't leverage and buy shares in the share market. But the language that was there is omnibus. If you need leverage from an Indian bank, NBFCs are not included. You've got to go to the central bank and get permission and do it. Most PEs try to raise money offshore for leverage and give it. I didn't clearly hear your first and second
First
question.
one was on talent, anyone. Now, when you buy out, do you have challenges in attracting talent?
No.
Good.
Basically, the PE, you have to run the company for a couple of years, turn around. So you need to put the people over there, to guide the CEO or fire CEO for the daily activity from the management. So where's it from investing firm? Where's the talent? So how you
We don't run the company. So if we do a buyout, we have people from the outside run the company. And like any country, really good talent is hard to find, but that's part of the challenge, right? And if you find good people to run the company, and even in a buyout situation, we are not running the company. Running the company is up to the CEO and the management team that we hire. And if they don't do a good job in a buyout situation, we have the chance to replace them. But if we come to that point with replacing management team, that's not a good outcome. So talent is there. It's good and great talent, hard to find. Of course, that's what good, great stuff is hard to find anyway.
Gautam, he talked about government, and you want to wrap up with answering on that. How is the government looking at buyouts and regulations and so on? Thank you.
On the buyout side of things, look, the government does not have a view per se on buyouts or the other way around. Of course, they are more keen to develop markets, to have a more robust economy. So from that perspective, there is no challenge. Going back to what Shankar mentioned on the LBO side of things, LBOs typically do tend to happen offshore. You raise capital offshore. You are not allowed to create security on Indian assets, as Shankar was mentioning. The Indian banks are not allowed to. But there are structures to create an LBO. Is it commonplace? No, because we haven't felt the need for it. The day we feel the need for it, there will be a very robust market. Forget that. We don't even have a very robust debt market for that. But we are still a very, very vibrant economy. India adapts to whatever needs to be adapted on a priority basis. We will get there. Taking off from what Saurabh had mentioned, we are a double lane highway, pothole. We'll get there. So far, it's been working just fine for us. And the government will be there to support us. This is what I was mentioning earlier. All the bureaucrats, the judiciary, earlier they were not so commercially savvy. Now there's enough support from them as well when it comes to a more nuanced transaction. So going forward, we will see more and more support from the regulators.
Thank you so much, audience and speaker panelist, for the interactive session. Now, I would request all the panelists to step up for a quick group photo. Thank you. Now, I would request the panelists to stay up and invite Mr. Nagarajan from Zenith HR to give away mementos. request Gautam and Venkat to remain on stage. We will now have a short function to give away the first set of Apex PVC awards. Now, before we start that, I would like to give a quick brief of what we do at these awards. So this was launched in 2007. The Apex Awards aim to recognize the leading private equity and venture capital transactions of the previous calendar year. The shortlisting of these awards are done by the nominations submitted themselves by the PVC funds and also the exit transaction details that we get from Venture Intelligence Private Equity VC database. We've also crowdsourced these votings from limited partners, PVC, and advisory communities. The awards this year received participation of more than 2,500 folks from across PVC ecosystem. A big thanks to all of them to help us bubble up the best. The first award of this evening is the Private Equity Investor of the Year 2023. This PE giant completed its exit with a 10.7 times return in US dollar terms from its automobile parts portfolio company in 2023. During its ownership period, this investor transformed what was a traditional auto component supplier into a new age electric vehicle supplier, servicing 1 in 8 EVs sold globally. Combined with prior proceeds from the company's IPO in 2021 and the first block trade in 2022, the total realization from the exit was 1.8 billion at a total of IRR of 150 plus percentage. The firm also completely exited its 30% stake in a travel software company, fetching $450 million during 2023. To announce the winner of this private equity investor of 2023, we invite on stage Gautam Singh from Trident.
And the winner is Blackstone.
To receive the award, we invite on stage Ganesh Mani and Amit Dalmia, Senior Managing Directors at Blackstone. In case anyone has not guessed already, the auto parts company was Sona Comstar and the travel software company was IBS. Ganesh, with a couple of lines from you guys. Standout names.
Thank you, Venture Intelligence, for bestowing us with this prestigious award. It's an absolute honor to receive this award on behalf of all my team members who work relentlessly to make us who we are. So this award belongs to each one of them. I'd also like to say that this award belongs to all our Global Investment Committee members who have been super supportive of India and has been supportive for us throughout various cycles. India is number one geography for Blackstone globally. We have close to $50 billion of assets across both private equity and real estate business. And as we scale our business further, we focus on our three value creating levers. Number one is our philosophy to build business with Blackstone. So we focus on building strong, resilient business. The second is our approach for alignment, strong alignment with the management team. And the third, which is most important, is to have a relentless focus on creating value and returns for our investors. So thank you, Venture Intelligence.
Amit said it all. Thank you, everyone. Thank you to the jury, to Venture Intelligence. Our focus remains to build businesses in India, not just buy and sell. There's something to buy and sell. That's not for us. We are here to build businesses and do it in partnership with management. So thank you, everyone.
Thank you again. Congratulations. Next award of the evening of today's Healthcare Investor of the Year 2023. This homegrown healthcare focused growth capital firm achieved as many as 5 complete exits in 2023 and also made a first close on its new fund. The exits included a well-known skincare services firm fetching 3.6x, a medical devices maker with a 3.7x return, and a pharmaceutical company fetching 2.7x. To announce the winner of the Healthcare Investor of the Year 2023, we invite on stage Venkat Subramaniam, founder and director.
The winner is Investment.
We invite on stage TP Devarajan, Senior Managing Director, Investment. Congratulations, Team Investment. Deva, your side.
It's been a great journey over the last 16 or 17 years. We started with a small fund of about less than 100 million. Over time, we've deployed close to about 600 million in the Indian market. We're raising another 300 plus now. And we should cross about $1 billion in deployment over this fund cycle. We built a great portfolio of 33 companies and two more from the new fund. It's their hard work and the hard work of our team that has got us this award. So I thank everyone here for having voted for us and for Venture Intelligence to kind of put us into the shortlist. Thank you very much.
Thank you, everyone. We'll now go for a networking break and join back for our next session. Well, we also have one more session left, one more award left here. So we have something called as League Tables and Venture Intelligence. To give you a brief. Venture Intelligence League Tables is the first such initiative exclusively tracking transactions involving India-based companies are based on the value of MP and M&A transaction advised by financial and legal advisory firms. As you would all agree, these service providers play a key role in the efficient functioning of transaction system, where private equity or M&A. We would like to use the Apex platform to hand over a plug to the top transaction advisor of the private equity deals in 2023. We request our founder Arun Natarajan to come on stage and give away the plug. The top transaction advisor of PVC deals in 2023, including financial advisory, due diligence, tax, and other advisory services, is none other than PwC. We request PwC partners Bhavin Shah, Dinesh Arora, Akshay Kapoor, Tushar, and Kunal Shah to come on stage to receive the plug from them.
Thank you. That is very short. I just want to thank all the PwC partners who are focused on this. This is very special for us because actually this is the 10th year in a row that we've topped the tables. Thanks a lot.
Thank you, everyone. We'll join back at 12 for our next session.